First, let's define profitability. Profitability is a measure that indicates the profitability of a trading strategy. It is calculated as the difference between the win rate and break-even win rate of the strategy. The break-even win rate is the win rate at which the profits and losses of the strategy are equal. In other words, it's the win rate at which the trader breaks even. However, calculating these metrics in intraday trading can be challenging due to the difficulty in obtaining accurate and timely data. As a result, profitability is not often used in intraday trading. That being said, the Walk Forward Algo Trading tool simplifies the process of calculating profitability by continuously backtesting and forward testing the intraday data with no repainting errors. This makes it easy for traders to monitor the effectiveness of their strategy without the challenges of calculating win rate and break-even win rate. Profitability is a valuable metric because it allows traders to assess the potential profitability of their strategies. By comparing the win rate of their strategy to the break-even win rate, traders can determine whether their strategy is profitable or not. If the win rate is higher than the break-even win rate, then the strategy is profitable, and the trader can expect to make money over time. If the win rate is lower than the break-even win rate, then the strategy is not profitable, and the trader should consider making changes to the strategy or abandoning it altogether. Profitability can vary from day to day due to the constantly changing market conditions. Intraday traders must adapt their strategies to changing market conditions such as market volatility, news announcements, and price movements. As a result, the win rate and break-even win rate can fluctuate, which can impact the overall profitability of the strategy. Additionally, market conditions may be more favorable for certain trading strategies on certain days, resulting in higher or lower profitability. For example, a strategy that is based on trend following may perform better during periods of strong price trends, while a strategy based on mean reversion may perform better during periods of sideways price movement. Therefore, traders must continuously monitor the market conditions and adjust their strategies as needed to maintain consistent profitability over the long term. Profitability tends to decrease as risk increases because higher levels of risk increase the likelihood of experiencing larger losses. When a trader increases their risk, they may have to widen their stop loss to accommodate larger price movements, which means that a losing trade may result in a larger loss. Conversely, if a trader reduces their risk, they may be able to place tighter stop losses and reduce the potential size of their losses. Although reducing risk may also reduce the potential profit on a winning trade, it can help to limit the impact of losing trades, resulting in more consistent and profitable trading over the long term. Therefore, it is important for traders to find a balance between risk and reward that maximizes their profitability while minimizing their risk. Higher win rates can often produce lower profitabilities because a high win rate alone does not guarantee profitability. Even if a trader has a high win rate, the size of their winning trades must be larger than the size of their losing trades to generate a profit. If a trader has a high win rate but their winning trades are small and their losing trades are large, the overall profitability of their strategy may be lower. On the other hand, a trader with a lower win rate may still be profitable if their winning trades are significantly larger than their losing trades. Therefore, it is important for traders to focus not only on their win rate but also on the size of their winning and losing trades, as well as their risk-to-reward ratio, to determine the profitability of their strategy. Higher break-even win rates can often produce lower profitabilities because break-even win rate represents the minimum win rate required for a trading strategy to break even, meaning that the profits from winning trades are equal to the losses from losing trades. While a high break-even win rate may seem desirable as it indicates a lower risk of loss, it can also limit the potential profitability of a trading strategy. A higher break-even win rate implies that the size of the winning trades must be significantly larger than the size of the losing trades to generate a profit, which may not always be feasible in the market. Therefore, traders should consider not only the break-even win rate but also the risk-to-reward ratio and the size of their winning and losing trades to determine the overall profitability of their trading strategy. A high break-even win rate is typically produced by a trading strategy that has a low risk-to-reward ratio. The risk-to-reward ratio is a measure of the potential profit versus the potential loss on each trade. A low risk-to-reward ratio means that the potential profit on a trade is relatively small compared to the potential loss. This, in turn, requires a higher win rate to break even, as the trader needs to win a greater percentage of their trades to offset the losses. As a result, a trading strategy with a low risk-to-reward ratio and a high break-even win rate may be more difficult to execute profitably over the long term, as it may require an impractically high win rate to generate profits. Traders should aim for a balance between risk-to-reward ratio and break-even win rate that allows for profitable trading while minimizing risk. Now, let's talk about how the Walk Forward Algo Trading tool can help intraday traders assess their profitability. The tool automatically displays the profitability under all win and loss conditions, which allows traders to see how their strategies perform in different market conditions. For example, if a trader's strategy has a high win rate but a low profitability, the trader can see if this is due to losses in certain market conditions or if the strategy needs to be adjusted to increase profitability. Additionally, the Walk Forward Algo Trading tool allows traders to backtest their strategies on historical data and then forward test them on live data to see how they perform in real time. This helps traders assess the viability of their strategies and adjust them as needed to improve profitability. In summary, profitability is a valuable metric for intraday traders, as it allows them to assess the potential profitability of their strategies. The Walk Forward Algo Trading tool can help traders assess their profitability under different market conditions and backtest their strategies to improve profitability. To determine how effective the strategy is, we will vary the risk-to-reward ratio. Begin testing the strategy using a risk-to-reward ratio obtained from our 1/S2 price levels. This will serve as a benchmark for comparison with other ratios. The R1/S2 risk-to-reward ratio uses resistance level 1 for the limit and support level 2 for the stop loss for long trades. Use the Walk Forward Algo Trading tool to test a range of risk-to-reward ratios, ranging from 0.50 to 10.0. Testing ratios that are higher and lower than the R1/S2 risk-to-reward ratio to show how the strategy performs at different price levels. Use the Walk Forward Algo Trading tool to both forward test and back test the strategy at each risk-to-reward ratio. This will help determine how the profitability of the strategy varies with changes in the risk-to-reward ratio. Compare the results of the forward testing, back testing to determine which risk-to-reward ratio works best for the strategy. This will help determine if the results from back testing are applicable in live trading conditions. Then find a ratio that maximizes profitability while minimizing risk. Testing different risk-to-reward ratios may find other aspects of the strategy that need to be adjusted. Consider fine-tuning your strategy by adjusting the entry and exit criteria or stop loss and take profit levels. Beginning with the R1/S2 risk-to-reward ratio, set the risk-to-reward setting to 0. Observe that the forward test profitability is 100% and the back test profitability is 36%. Set the risk-to-reward ratio to 0.50. Observe that the forward test profitability is -1% and the back test profitability is 34%. Set the risk-to-reward ratio to 1.0. Observe that the forward test profitability is 21% and the back test profitability is 18%. Set the risk-to-reward ratio to 1.5. Observe that the forward test profitability is 11% and the back test profitability is 8%. Set the risk-to-reward ratio to 2.0. Observe that the forward test profitability is 100% and the back test profitability is 46%. Set the risk-to-reward ratio to 2.5. Observe that the forward test profitability is 100% and the back test profitability is 49%. Set the risk-to-reward ratio to 3.0. Observe that the forward test profitability is 100% and the back test profitability is 45%. Set the risk-to-reward ratio to 3.5. Observe that the forward test profitability is 100% and the back test profitability is 55%. Set the risk-to-reward ratio to 4.0. Observe that the forward test profitability is 100% and the back test profitability is 52%. Set the risk-to-reward ratio to 4.5. Observe that the forward test profitability is 100% and the back test profitability is 50%. Set the risk-to-reward ratio to 5.0. Observe that the forward test profitability is 100% and the back test profitability is 47%. Set the risk-to-reward ratio to 5.5. Observe that the forward test profitability is 100% and the back test profitability is 45%. Set the risk-to-reward ratio to 6.0. Observe that the forward test profitability is 100% and the back test profitability is 43%. Set the risk-to-reward ratio to 6.5. Observe that the forward test profitability is 100% and the back test profitability is 41%. Set the risk-to-reward ratio to 7.0. Observe that the forward test profitability is 100% and the back test profitability is 39%. Set the risk-to-reward ratio to 7.5. Observe that the forward test profitability is 100% and the back test profitability is 38%. Set the risk-to-reward ratio to 8.0. Observe that the forward test profitability is 100% and the back test profitability is 36%. Set the risk-to-reward ratio to 8.5. Observe that the forward test profitability is 100% and the back test profitability is 35%. Set the risk-to-reward ratio to 9.0. Observe that the forward test profitability is 100% and the back test profitability is 33%. Set the risk-to-reward ratio to 9.5. Observe that the forward test profitability is 100% and the back test profitability is 32%. Set the risk-to-reward ratio to 10.0. Observe that the forward test profitability is 100% and the back test profitability is 31%. The R1/S2 forward test risk-to-reward ratio of 100% and back test risk-to-reward ratio of 36% is on target when compared to the risk-to-reward ratio range. Thus the strategy is sound and produces reliable results. Summary facts and questions. Question: what is Walk Forward Algo Trading? Walk Forward Algo Trading is a tool that helps traders achieve consistent profitability in intraday trading. The tool allows traders to dial in any risk-to-reward ratio and automatically displays the profitability under all win and loss conditions, making it easy to identify profitable trading strategies. Question: what is profitability in intraday trading? Profitability is the difference between the win rate and break-even win rate. It is a measure of how much a trader can expect to earn on average per trade. Question: why is profitability not often used in intraday trading? Calculating win rates and break-even win rates in a timely and reliable manner can be difficult for intraday traders. However, the Walk Forward Algo Trading tool makes it easy to display profitability through continuous backtesting and forward testing of intraday data. Question: why does profitability decrease as risk increases? Profitability decreases as risk increases because the trader is risking more money per trade. This means that losing trades will have a bigger impact on the overall profitability of the trading strategy. Question: why do higher win rates often produce lower profitabilities? Higher win rates often produce lower profitability because the trades that are won may not have as high of a risk-to-reward ratio. This means that the trader may be earning less per trade, even though they are winning more trades overall. Question: why do higher break-even win rates often produce lower profitabilities? Higher break-even win rates often produce lower profitability because the trades that are won may only just break even, meaning that the trader is not earning a significant profit per trade. Question: why does profitability vary from day to day? Profitability varies from day to day because market conditions are constantly changing. Different market conditions can have a big impact on the success of a particular trading strategy. In conclusion, by using the Walk Forward Algo Trading tool to vary the risk-to-reward ratio and test the profitability of the strategy at different levels of risk and reward, one can determine the most effective ratio for the strategy and make informed trading decisions.